A very good evening, guys. We start with the next chapter, that is amalgamation of firms in your financial accounting subject, or you call it as accountancy and financial management for BCom students and financial accounting for BAF students. Now see, majority of your SYBC in accounts, you all have studied partnership accounts, which included final accounts, admission, retirement, death of partner, also dissolution. Now everything you are going to study in your second year degree college also. Piecemeal distribution we have done. We know, we have discussed many times, it is connected with dissolution of firms. When the firm is dissolved, then only piecemeal comes into picture. Then we will be also doing partnership final accounts, which will be a revised version of your SYBC but at an advanced level, which includes final accounts along with retirement, admission and death. And now what we are going to do is again a continuation of partnership accounts only, but it is a different format. We call the chapter as amalgamation of firms. Now amalgamation is a very important concept, because this chapter you all are going to learn in your next year TY also. The only difference is what you all are going to study this year, what we are starting today, is amalgamation of firms, that is partnership firms. And what you all are going to do in third year, the final year of your graduation, that will be amalgamation of companies. But the concept remains the same. Okay? So we start today with the chapter amalgamation of firms. Firm means partnership firm. Now what is amalgamation? Amalgamation is nothing but it is a process where more than one partnership firm join hands together to expand their business at a larger scale. Say for example, there is one company, say AB and company, there's another company CD and company. Fortunately the same names are there in the first sum. There's one partnership firm having partner A and B. There's another partnership firm having partner C and D. Now both are doing independent business. They are into same business, but A and B is having their separate business. C and D is having their separate business. Now what they decide? A and B says, we are operating, say for example, only in Mumbai. C and D is doing same business in some part of Mumbai, also Bangalore and say some other cities. Now what these two firms decide? Let's do one thing. Let's join hands together. Two partners AB, two partners CD. Let all four of us merge together. Form a new firm, A, B, C, D and company. So what we can do? We can capture a higher market of India and expand our business. So by doing that, volume of business increases. The business of AB and company will also increase. Business of CD and company will also increase. Profit of AB increases, profit of CD increases. Together the profit will double, triple. So automatically all the four partners also get a higher share of profit, as well as they can capture higher market. So that is the concept of amalgamation of firms where more than one partnership firm join hands together and they continue the new firm in the revised name, where all the partners of the old firm continue to become the partners of the new firm. Of course, the option will be given that if some particular partner doesn't want to be a part of amalgamation, he can leave the business. The firm will pay certain money. Say for example, AB is there, CD, they join hands together. A says, no, I don't want to continue. So B will give money to A, B, C and D will join hands together. So it depends upon individual choice of the partner whether he wants to continue and be a part of the new firm or no. So the concept of amalgamation of firms, the meaning of amalgamation of firm is two firms joining hands together, maybe more than two firms, forming into a new firm and doing combined business to gain a larger share of market. That's the concept of amalgamation. Now, we are studying accounts, correct? So when we study accounts, our main focus is on the aspect of accounting. The main aspect is aspect of accounting, how to do the accounting. Now, before we do the accounting ka part, when the firm decides to amalgamate, remember, new firm is being formed. So what will happen? The old firm like that only will not agree. There has to be some benefit or some consideration which is to be given to the old firms. Then only they will decide to amalgamate. Nobody is a fool just to close their business like that and start a new business like that. So what will happen? A, B will say, C, D will also will say, we are doing independent business since years, no problem, we'll merge together, but whatever efforts we have put in our existing business over a period of years, we should also get the benefit of that. So that benefit, they get it in a form of consideration, and for that, we have to prepare a separate statement which will be the starting of each sum of amalgamation, that is statement of purchase consideration. That is statement of purchase consideration, commonly short form abbreviation we call it as PC, purchase consideration. Purchase consideration is the starting base of each and every sum of amalgamation, not only in this year but also in your final year. Now let's come into detail. What do you mean exactly by purchase consideration? As I mentioned, it is nothing but it is a statement showing the consideration payable by the new firm to the old firm. Now see, when you take over somebody's business, what you will do? You will not take over the individual persons. They will come with you. But what you will take from business is the business assets and liabilities. So the existing assets and liabilities of old firm will now become the asset and liabilities of the new firm. Not all. Some assets, the old firm will say, no, we won't give our assets, few assets. We will give our assets, but few assets we will like to retain or we will like to sell it because we'll get a higher price. So majority of the assets along with few or say all liabilities will be taken by the new firm from the old firm, and the new firm will give some consideration to the old firm, that is called as PC, purchase consideration. So purchase consideration is nothing but the value arrived by mutual understanding between the new firm and the old firm for the assets and liabilities which are taken over by the new firm of the old firm. So the value assigned for taking over the business is taken over in the form of assets and liabilities is called as purchase consideration. So for that, you can just see I have just prepared the statement. Of course, we will fill up when we start the sum. So statement of PC is nothing but the details of all asset at the agreed value minus the details of all liabilities at an agreed value, which gives you the value of the existing firm, which the new firm will pay to the old firm. Now, new firm will not pay to the old firm in the form of cash. That we will see later on how the new firm pays. But first, you have to focus on the statement of PC ka part. So, this statement of purchase consideration will be prepared by each and every firm. Let it be the new firm, let it be the old firm. And when you all are solving the sums, your every sum will start with statement of purchase consideration. Without this, you cannot proceed further. You cannot do any sum on amalgamation. Remember, if it is a 15 mark sum, minimum 3 marks, 3 to 5 marks are allocated for this. It depends. If there are more adjustments, this will be having a weightage of 3 marks. And if there are less adjustments further, this will be having a weightage of 5 marks. But this is very important, not only from that weightage of marks point of view, but for the further part of sum. Because if you make a mistake here, aage ka sum mein there will be an effect of this. So there also there will be a mistake. Okay. So the first thing what you have to start with the amalgamation of firms का all the sums. Every sum will start with statement of PC. How to do that? That we'll see in some time. Now, this is a statement. Coming to the accounting part, there are two things. Accounting in the books of old firm. Old firm is the firm which is shutting down, winding up, and accounting in the books of new firm which is taking over the old firms. Accounting in the books of new firm which is taking over the old firms. Now, when it comes to accounting of old firms, accounting can be in any form. They can ask you in the form of ledger accounts. They can ask you in the form of journal. Majority of the sums are based, 90% of the sums are based on ledger. Very few are based on journal, but we will not skip anything. I will make you do the sums in the form of journal also. In exam, the chances of sums along with the journal for the old firm is comparatively less. I would say 5 to 10% of sums being asked on journal, but we will do at least 2 sums. I'll try to solve 2 sums along with the journal. It's nothing very simple. Once you know the ledger ka part, journal is nothing but picking up the entries from the ledger only. So accounting of old firms in the form of ledger or journal. Then you have accounting in the books of new firm. Now, new firm mein you do not have ledger accounts. Either you have to prepare only balance sheet. Ledger account, if required, that is only for a part of working note, not main ledger. And or journal. Matlab, balance sheet you will have to prepare in mostly all the sums. Journal, very few cases where there is specific adjustments or the question mentions. And in few sums, working notes wherever required. That we will see at a later stage. Slowly, let's start with the basic part and then we will go to the advanced sum. Now the total number of sums to be solved in amalgamation is comparatively lesser than the other chapters, but the sums will consume time. Every sum will go in minimum 3 to 4 pages. How to do? Let's start. And before that, again I am repeating 3 things. Statement of purchase consideration in each and every sum. Closing the books of accounts of the old firm, either journal or ledger. But if you do journal, ledger you have to do it in draft. Keep that in mind. And journal up now. Accounting of new firms may be in the form of balance sheet or balance sheet and journal, and wherever required in the form of working notes. Now before we start the sum from the question sheet what you'll have in front of you or the textbook what you'll have in front of you, I am taking one extra question. I have prepared one very basic extra question which is in front of you all. So what I am doing is, today in the first class I am solving this entire sum. Okay, now see, entire sum most probably will not fit in one video, so we will split it up. Okay, let's start reading the sum. The first part we will prepare statement of purchase consideration, and after that we will see how to prepare the ledger and how to close the books of old firm and then the new firm ka balance sheet. Everything we are going to do in the first sum. Don't worry, it's a very simple chapter. Just understand this sum very carefully, because if you get this first sum, assume that you are thorough with the 60 to 70% of the base of this chapter. Okay, so let's read the sum and then we will go step by step as per the flow of the question. The extra question which I have put in the app. Okay, let's see. Following is the balance sheet of Mrs. AB and Company and Mrs. CD and Company, having partners AB and CD respectively as on 31st March 14. On 1st April 14, both the firms decided to amalgamate and open a new firm in the name of Mrs. AB, CD and Company. The same names what I put in the example. Now remember, AB is one independent firm, CD is another independent firm. AB and CD now merge together. They close their independent firm and form a new firm called as AB, CD and Company. Balance sheet is given, both AB, CD. This is the way question. In every sum they will give you 2 firms ka balance sheet, because amalgamation hai, so there has to be minimum 2 firms. Okay. Capital, now see, first is AB, second is CD. So capitals A, B, C, D, general reserve, creditors, bills payable, land and building, plant and machinery, furniture and fixtures, stock, cash and bank debtors. Additional information, all the assets and liabilities were taken over at book value except the following at revised value. I'll tell you when we start the statement. They have given you A, B and C, D ka revised value of 3 assets, land and building, plant and machinery, furniture and fixtures. The profit sharing ratio of Messrs. A, B and company is 3:2, whereas that of C, D and company is 2:1. Prepare necessary accounts to close the books of both the firms and prepare balance sheet of new firm. We could have avoided preparing balance sheet, but balance sheet of new firm is very simple. Once you get these accounts, the balance sheet of new firm is very, very simple. Okay. Now, first thing, as I told you, whether you are doing accounting of new firm, whether you are doing accounting of old firm, the most important thing what you are supposed to do is statement of PC. That is statement of purchase consideration. Now what I told you, how the business will be taken over. The business will be taken over in the form of assets and liabilities. The business will be taken over in the form of assets and liabilities. So first you will prepare, this will be the format common for all the sums. Statement of purchase consideration, particulars, the first old firm, in this case Messrs. A, B and company, the second old firm, in this case Messrs. C, D and company, and total. Total ka column, even if you ignore it's fine, but I would prefer doing it because it makes a little bit balance sheet ka calculation and presentation easier. But there are few colleges who avoid this. I would suggest keep it, no harm in putting one extra column. So see, particulars, the first old firm A, B and company, the second old firm Messrs. C, D and company, and the total. Total mein the figures what you put for A, B and C, D, uska total will come. Now what I told you, what the new firm will do, they will take over the business in the form of assets and liabilities. So the first thing you will start with the details of all assets taken over. So my first heading will be assets taken over. My first heading will be assets taken over. Now see the asset side. How many assets are there? Land and building, plant and machinery, furniture, stock, cash, bank, debtors. Now there are total 6 assets. Now you have to see in the question. There's a possibility all 6 assets may be taken over by the new firm, or there might be few assets which may not be taken over. Now in this basic sum, I have not kept that exception of assets not being taken over. All the assets are taken over. If you see, nowhere in the question they have mentioned that this particular asset is not taken over. You have to read the question carefully because there will be cases aage jaake where a particular assets may not be taken over. Okay? Now listen. So 6 assets all are taken over. So what you will do, understand very carefully, I am going very slow. You will list down all the 6 assets. You will list down all the 6 assets because all are taken over. Now what about the value? They may give you revised value. Like how in this case, adjustment number 1. Revised value of land and building, plant and machinery, furniture and fixture is given. So wherever they give you revised value, you will put the revised value. Where the revised value is not given, where the revised value is not given, you will record the book value. Book value means the value appearing in the books of accounts, the value appearing in the question ka balance sheet. The value appearing in the books of accounts, the value appearing in the question ka balance sheet is called as book value. So I'll repeat. You will list down all the 6 assets, whatever assets are taken over, in this case all. Where the revised value is given, you will put the revised value, and where revised value is not given, the book value, that is the value appearing in the balance sheet. Now let's take one by one. Let's focus right now only on the asset side. Now see, land and building. A, B and C, D, दोनों के books में there is land and building. Have they given you revised value? Yes. AB ka balance sheet value is 80, but the revised value is 110. CD ka balance sheet value is 75, but the revised is 102. So where revised value is given in the statement of PC, you will take the revised value. Okay? So let's start. Assets taken over में first land and building, revised value from the first adjustment. A B का 110, C D का 102. So the total becomes 2,12,000. Okay? 110 plus 102, 212. I'll repeat. Revised value is coming from adjustment number 1. Same way. Next, plant and machinery. Old values are there. Have they given the revised value? Yes. When they give you revised value, from the statement of PC point of view, forget the value which is there in the balance sheet. Take the revised value. Yes, plant and machinery, revised value given. So, take next. Plant and machinery. What is the revised value given? AB ka 40,000, C ka 30. So 40 plus 30, that is 70,000. 40 plus 30, 70,000. Let's go as per the order of balance sheet. Next, furniture and fixture. Again, adjustment number 1 में furniture and fixture given 25 and 20. Okay, revised value is given. Furniture and fixtures 25 and 20, that gives you 45,000. 25 and 20, 45,000. So adjustment number 1 में 3 revised values given: land and building, plant and machinery, furniture and fixtures, and we have taken those revised values here. Okay guys, now see. Next, stock. Can you see below any revised value of stock? No. So there is no information about stock not being taken over. That means stock is taken over. So if an asset is taken over, the revised value is not given, we will take the balance sheet value. So what you will do is, we will take stock, the balance sheet ka figure, that is 25 and 30, that is 55,000. 25 and 30, that is 55,000. Cash and bank. Have they given us the revised value? No. So we take the balance sheet value. It's very rare cash bank ka revised value, because cash bank is the value what you have. Unless and until you are paying to somebody or you are receiving from somebody before the amalgamation or on amalgamation, then only the amount will change. Okay? So cash and bank, again we will take the book value, that is 10,000 and 15,000. So 10 plus 15 gives me 25,000. Next, debtors, again no revised value given, so we take debtors at book value. Again I am repeating, book value means the value appearing in the books of accounts. For y'all it is in the balance sheet. So debtors 15,000, 15,000. So 15 plus 15, that is 30,000. 15 plus 15, that is 30,000. Clear guys? Got it? Now listen. No other assets. So these are the 6 assets taken over. Before we go to the second part of this, that is liability, first let us take the total. So what do? You will take the total of all the 3 columns, and this total you will call it as A. A means the total value of assets taken over. Let's see the total. 110 plus 40 plus 25 plus 25 plus 25. So 2,25,000. 102 plus 30 plus 20 plus 30 plus 30. 2,12,000. And let's take the total of this. 212 plus 70 plus 45 plus 55 plus 25 plus 30. 437. 225, 212, 437. Now listen. When you take the total of this last column of cross check, the total of AB plus total of CD automatically should give this total 437. So AB ka total 225, CD ka total 212, 225 plus 212, that gives you 437. Okay? From this, now what are we finding out? What is the heading? Your heading is statement of purchase consideration. Now how you get it? What I told you, when any business is taken over, the business is taken over in the form of assets and liabilities. So what we do is, we have taken the total of assets. Now from this, to get the PC, we will deduct the value of liabilities. So now what you will do from here is, less liabilities taken over. I just put it here so that doesn't. Less liabilities taken over. Now, after the assets, we take the liability ka part. Now, remember very carefully. When you take over liabilities, you will take over only external. External matlab that which is payable to outsider. You will take over only external. External means that which is payable to outsider, and external will not include capital and reserves. It will include all other liabilities which is payable to outsiders, or in case of partners, if there is any loan, but it will not include capital and reserves. So the liabilities taken over will not include capital and reserves. Now let's see in the question. See the liability side. How many liabilities you have total? 4. Capital, general reserve, creditors, bills payable. Now partner ka capital is payable to the partner itself. So it is in the form of owner's money. Capital is the person money introduced by the partners to start the business. So capital will not come. General reserve, you all know, piecemeal distribution mein general reserve we have distributed among the partner. That belongs to partner. Internal liability will not come. Creditors, yes, payable to outsiders. Bills payable, yes, payable to outsiders. So only 2 liabilities will come, creditors and bills payable. Now, can you see आगे in the further question adjustment में creditors and bills payable का revised value? No. Creditors and bills payable का revised value is not there, so you will take the book value. Creditors and bills payable का revised value is not there, so you will take the book value. So liabilities में creditors, bills payable. No revised value given, so we will take the book value. कितना है creditors? 15 and 28. So 15 and 28. 15 plus 28 will give you 43,000. Bills payable 10 and 20. So bills payable 10 and 20. That is 30,000. I'll repeat, only 2 liabilities will come, that is creditors, bills payable, capital and general reserve. Both are internal liabilities, therefore it will not come. Now see, we took the assets ka total as A. Now we will take the liabilities ka total as B. We took assets taken over ka total as A. Liabilities taken over, we'll take it as B. So take the total. 15 plus 10, 25, 28 plus 20, 48, 43 plus 30, 73. As I told you, cross check the total of AB plus the total of CD. So 25 plus 48 should give you 73. This total you call it as B. Therefore, now my value of business will be nothing but the net value of assets and liabilities. Net value means asset ka value A minus liability ka value B. That becomes my final value of taking over the business of the old firms, which is nothing but the value of purchase consideration. That is the object, that is the agenda of preparing the statement of PC. So after B, next line write, therefore your PC, which we call it as purchase consideration, that is nothing but A minus B. Purchase consideration A minus B. So 225 minus 25, that is 2 lakhs, and 212 minus 48, 12 and 36, this will give you 164, 36, yeah, and A minus B, or you will say 2 lakh plus 164, that is 364. Let's cross check. 437 minus 73,364. Got it? So 364 is my total value of PC. I'll repeat again. Take the value of all the assets. Wherever revised value is given, call it as A. Take the revised value. Where revised value is not given, take the book value. Take the total, call it as A. Then take your liabilities. Liabilities will include only outsiders liability and partners loan if any. It will not include capital and reserve. Therefore, in this sum, we ignored capital, we ignored general reserve, and we took only the external creditors and bills payable. Revised value of creditors and bills payable was not given. Therefore, we took the book value, that is the value given in the balance sheet. Assets ka total we made it as A. Liabilities ka total we made it as B. So my purchase consideration was A minus B. Now how do you interpret? A ka purchase consideration 2 lakhs. B ka purchase consideration 164. Sorry, AB. AB ka 2 lakhs, CD ka 164. That means, now listen up, how do you interpret? The new firm ABCD will take over the business of AB for 2 lakhs, that is AB ka PC, and the new firm will take over the business of CD and company at 164, which is the value of CD and company. So that is the object, that is the intention of preparing to prepare this statement, so that we know the value at which the old firm ka business is to be taken over by the new firm. These two figures are very important because aage jaake in the next part of the sum we need these figures, because if these are wrong then you might make an error of finding the profit or loss also of the old firm, because it is solely based on this. But that is a different thing, we'll do after some time. But currently remember, again I am repeating, in every sum of amalgamation of firms, what you are supposed to do is find out the value of purchase consideration, which is nothing but the total of all assets taken over minus all liabilities taken over. So your PC is A minus B. A, the value of all assets, wherever revised value, take the revised value or the book value, that is the value in the balance sheet, minus B, that is liabilities ka total, again the same thing, where the revised value is given, take the revised value or as per the value given in the balance sheet. So in short, your purchase consideration will be A minus B. AB ka PC 2 lakhs. The new firm will have to pay 2 lakhs to AB. CD 164, the new firm will pay to CD 164. How they will pay, that we will study in some time. So this was the first part, statement of PC to be prepared in each and every sum. Got it? Now the second part. There are 3 parts in this question. First part we are done, statement of PC. Second part, closing the books of both the company, AB as well as CD, and the third part, balance sheet. Now after this, we take the second part, closing the books of AB and company as well as CD and company. First, we will close AB and company, which I have already prepared the format. Then I will continue CD and company in the next video. Just let me check whether I can do this in the current video. Let me see how much time is there. 36. Yeah, I can manage. Okay. Now see. Hopefully I should be able to do AB and company in this video. Then CD and company ka closing and balance sheet, I will take it in the next video. In case the video gets disconnected, I'll continue the remaining part in the next video. Okay. Now guys, the second part, closing the books of AB and company. Closing the books of AB and company. Now, when you close the books of old company, there will be minimum 3 accounts. 95% case mein there will be these 3 accounts only. Additional accounts only if the question mentions. Now what? SYJC, if you will recollect, you all had done a chapter called as dissolution. Dissolution means closing down the business. Amalgamation may also, the old firms are now merging or joining hands together with the new firm, so they are also closing their business. So whenever you close the business, the first account what you prepare is realization. So one account is realization, around half a page, or you can say 2-3 lines more than half a page. Then partners capital account with the number of partners. Here I am closing first AB and company. So AB mein there are 2 partners, A and B. So particulars AB, particulars AB. Okay? Only 2 partners of the first firm. So we will close that. And the next messes AB, CD and company, that is the new firm. So 3 accounts plus extra if asked in the question. If no additional accounts asked in the question, these 3 will be prepared in each and every sum. Realization, partners capital, new firm. I'll repeat, realization around half a page or 2-3 lines more than half a page. Partners capital around 5 lines, and the last account around 3 lines. Half a page, 5 lines, 3 lines. If you want, what you can do, from the bottom take 3 lines for this, above that take around 5 lines for this, and the above part you can keep it for realization. Realization will occupy majority part. So around 60 to 65% of the page for realization, around 20 to 25% for partners capital, and the remaining A, B, C, D and company. In short, you can say around 15 lines for this, around 5 lines for this, and 3 to 4 lines for this. Once you do the first sum, automatically you'll gauge the number of lines to be prepared. Okay? Now, we are just closing the books of the first company, AB and company. So now we will see the question and PC for the next 15-20 minutes only for the first firm, that is AB and company. Okay? Now listen. After preparing these 3 accounts, the first step is the posting. After preparing the first 3 accounts, the first step is posting. We are closing the accounts only of A, B and company. We are closing the accounts only of A, B and company. So the first thing is we will see from the question the data only relating to A, B and company. First step, let's see the posting. We will start from the liability side. Remember, for the next 15-20 minutes or till the time this video doesn't get over, we have to just see AB and not CD. Temporary for some time, ignore CD. Let's start the posting. AB. Capital is there. A ka capital 1 lakh, B ka capital 75,000. Similar posting what we used to do in SYJC. Capital always has a credit balance unless and until it is appearing on the asset side. Both are appearing on the liability side. Liabilities have a credit balance, so these two are opening balances. Opening balances on the liability side come to the credit side of capital. Right there. By balance brought down, A के कॉलम में 1 लाख, B के कॉलम में 75,000. A के कॉलम में 1 लाख, B के कॉलम में 75,000. Okay. Next, general reserve 10,000 for A, B and company. CD we don't need right now. Now see, general reserve is the profits kept aside by the partners. General reserve is the profits kept aside by the partners. When they need it, they will use it, or when the firm closes, they will take it. यहाँ पे the firm is closing down, so this general reserve of 10,000 is created by A and B due to their hard work, so they will take that. So in short, general reserve will be given to the partners. They will distribute in their profit sharing ratio. Reserve, profit and loss, general reserve, reserve fund of old firms is the profits created by them out of their hard work. They will distribute amongst themselves in their mentioned ratio. If the ratio is not mentioned, it will be equal, or if the ratio is mentioned, you will divide as per the mentioned ratio. Now what is the ratio given of AB? See the second adjustment. Ratio is 3:2. So this 10,000 we will distribute between A and B in 3:2. 10,000 you all know how to divide. 10,000 into 3 by 5 into 2 by 5, 6 and 4. So come to the credit side of capital right there. By general reserve, A 6,000, B 4,000. Those who want to do in Calci, those who are with me in FI, you know how to do. Again I repeat, 10,000 divide by 3:2. 3 plus 2 is 5. So what do you do? Divide by 5. 10,000 divided by 5 gives you 2,000. Press multiplication sign twice. I repeat, 10,000 is the amount to be divided. So put in your Calci, input karo 10,000. Divide by, the ratio is 3:2. 3 plus 2 is 5. So 10,000 divided by 5 karo 2,000. Now press multiplication sign twice. First partner A. A ka ratio is 3. So press 3 is equal to. See, you get 6,000. Put here 6,000. Now after 6,000, don't put anything else. Straight away put 2 is equal to. You get 4,000. So put here 4,000. So A ka 6,000. B ka 4,000. The profit of 10,000 will be distributed between A and B in the ratio 3:2. That gives you 6,000 and 4,000. Got it? So capital में by balance brought down, general reserve में distribute 3:2, 6,000, 4,000. What else there on the liability side? Creditors and bills payable. Now remember, the object of preparing realization account is, first step, transfer of all assets and liabilities. But it should not be internal, because if it is internal, it will go in the respective account. So what you will do, creditors and bills payable. If you all recollect SYJC ka dissolution, Same thing. External liabilities will be transferred to the credit side of realization. Capital and reserves will go on the credit side of partners' capital. External liabilities, that is payable to outsiders, will come here. How many are there? 2. Creditors and bills payable. Come to the credit side of realization. Give the heading by sundry liabilities. Give the heading by sundry liabilities. How many are there? 2. Now be careful, I'll explain you all. First creditors, then bills payable. Now listen very carefully. A very, very important point applicable for this entire chapter, also applicable in the next year. When I prepare the statement of PC, I will prepare and record the values which are agreed. Agreed means if revised value given, we take the revised value. If revised value not given, the agreed value will be the balance sheet value. So statement of PC mein I will take the revised value or I will take the book value. But remember, when you close the books of firm and when you put it in realization account, you will not take the revised value. Your values will come from the balance sheet for all assets and external liabilities, whether taken over or no. I am repeating. यहाँ पे you will take only those assets which are taken over. If revised value there, we take the revised value. If revised value not there, we take the book value. But when you close realization, here all the assets which are there will be taken over at the book value. Even if a particular asset is not taken over, it will come in realization at the balance sheet or the book value. There are 6 assets, all 6 are taken over. Here we took the revised value, where revised value was not given, we took the balance sheet value, but here everything will come at book value. Same thing for creditors and bills payable. Fortunately, creditors and bills payable ka revised value was not given, so we take the balance sheet value. Had we taken a revised value, here we would have taken only balance sheet value. So creditors and bills payable, we will take the balance sheet value only, that is creditors ka 15,000, bills payable 10. Remember, we are just doing the first firm, that is AB. So 15 and 10, 25,000. 15 and 10, that is 25,000. So external liability, credit side, we put it under the head sundry liabilities. Got it? So done with the posting of AB ka liability side. I'll repeat. Capital mein bar balance brought down. General reserve distribute in the profit sharing ratio 3:2. Remember, if profit sharing ratio is not given, then we will distribute equally. And creditors and bills payable, credit side of realization at book value. Come to the asset side. Land and building till debtors. All 6 are taken over. Now remember, realization account may only those assets will come which are realizable. When I say realizable, matlab those assets against which you can get money. You will get money either by selling assets or if there is recovery. Now when I say debtors, debtors are human beings. You cannot sell debtors. But debtors will pay you the money which they are supposed to pay you. So it is realizable because against debtors you will get money. Land and building, plant and machinery, furniture, all are realizable. You can sell and get money. Cash itself is in the form of hard cash. So that is realizable in its own form. Okay. Now come to the asset side. 6 assets. Again I am repeating. Here you will take the revised value if given. Otherwise the balance sheet value. But when you do the posting of assets on the realization account, it will be the book value, that is the balance sheet value, and not the revised value. Fit this in your mind. Again I am repeating. Statement of PC may, if revised value is given, you will take the revised value. If revised value not given, book value. Here you will take the book value or balance sheet value irrespective whether revised value is given or no. Liabilities, we put it on the credit side by giving the heading sundry liabilities. Assets, put it on the debit side by giving the heading sundry assets. So two sundry assets. All assets will come at balance sheet value. All assets will come at balance sheet value. Let's take one by one. Land and building, 80,000. Plant and machinery, 50,000. Furniture and fixtures, 30. Stock, 25. Cash and bank, 10,000. Debtors, 15,000. Total we already have 210. There was no need to waste time in totaling because everything came from the balance sheet figure, so the total also has to be balance sheet ka figure. Got it? So I'll repeat. We took each and every asset of A, B and company at the balance sheet value, that is book value. Got it? So the first part we are done, that is posting. Remember the first part of the second part of the question. The second part of question is closing the books. Uska first part is posting. Again I repeat, how we did the posting? Capital, opening balance, general reserve distributed, creditors, bills payable, book value on the credit side, and all assets on the debit side at the book value. Got it? Now guys listen. After doing the posting, first you have to see the adjustment. In case there is any asset which is not taken over, then how to deal with it. Now in this first basic sum, I have not kept that adjustment. So all assets are taken over. All assets are taken over. So everything has come. So that particular adjustment of any particular asset not taken over, how to deal with that doesn't arise in this sum because all assets are taken over. So first adjustment is already done. Second adjustment is just information. Now we come to the most important part, PC. As I told you, PC ka impact will come here also. Now which is the firm? A, B and company. Now see, the new firm A, B, C, D and company is taking over the first firm at what value? What is the PC of the first firm? 2 lakhs. What is the PC of the first firm? 2 lakhs. Now listen very carefully. 2 lakhs is the value which the new firm will pay to the old firm. 2 lakh is the value which the new firm will pay to the old firm. Now listen. Old firm ka business is going out. Old firm ka business is going out to the new firm. Credit what goes out. So business goes out. So I will credit realization. The business is going out. Now, who is taking over the business? The business is being taken over by the new firm, that is A, B, C, D and company. So for the old firm, it is an income. Business is going out. At the same time, it is an income because they are going to get it from the new firm. So what you will do, come to the credit side. After creditors, bills payable, leave one line. By Mrs. A, B, C, D and company account. If you want for presentation, you can put in brackets PC. I repeat, business is going out. For the old firm, it is an income. So you credit the new firm. Why new firm? Because this money of 2 lakhs you are going to get it from the new firm. So by A, B, C, D and company account, that is 2 lakhs. By A, B, C, D and company account, that is 2 lakhs. Now listen, we are preparing A, B, C, D and company ka account. We are preparing A, B, C, D and company ka account. So this will come on the debit side of A, B, C, D and company. It is coming from where? Realization. So to realization account, that is 2 lakhs. So I'll repeat, by A, B, C, D and company 2 lakhs and A, B, C, D में to realization 2 lakhs. Logic? Income for the old firm, so I credit realization, and it is receivable from the new firm, so I debit new firm to realization account 2 lakhs. Remember, from objective point of view, realization account is a nominal account and ABCD is a firm, it's a personal account. Nominal account, credit the gains and income, so I credited realization, and ABCD personal account, so I debit the receiver. I am going to take the benefit. ABCD is going to pay me money for the assets and liabilities which they have taken over. They are taking over my assets and liabilities, so they are the receiver. I have to recover money from them, so I have debited their account. So every old firm when you close, PC, credit realization and debit the new firm. Got it? Now the next step. No other adjustments affecting the old firm. Understand this very carefully, because the next firm CD you have to do in the same way. Next step, I will close realization account and get the profit loss. See which side is greater. Debit side 210, credit side 225. So credit side is greater. So 2,25,000. 225 minus 210. So the difference is 15,000. 225 minus 210, the difference is 15,000. This 15,000 is nothing but profit. If credit side is more, it is a credit balance, difference comes on the debit side, profit. If debit side is more, debit balance, the difference goes on the credit side, which will be loss. Now this is the profit or loss appearing in the realization account. So this is called as realization profit or loss, and it will be distributed between the two partners A and B in their profit sharing ratio. So what do you do? Write like that. To realization profit, underline A, B. B के line में this 15,000 should be there. This 15 will be distributed between A and B in their PSR. If the ratio is not given equal, if the ratio is given in the ratio. 3:2 is the ratio of A and B. So 15,000 divide, again I'll show you in the calci. 3 plus 2 is 5. So 15,000 divided by 5, you get 3,000. Press multiplication sign twice. A ka share is 3. So into 3, 9,000. B ka share is 2. So into 2, you get 6. So the ratio in which you divide, after dividing 15,000 may say 9,000 will go to the credit of A and 6,000 will go to the credit of B. That means you have to pay A 9 and pay B 6,000. Got it? So realization profit loss will be divided between the partners in the ratio in the ratio 3:2 in the sum, which gives you 9 and 6. To realization profit which goes to A and B, we are preparing capital of A and B. Profit will go on the credit side. So come to the credit side by realization account 9,000, 6,000. By realization account 9,000, 6,000. Got it? So we are done with the realization account. Profit loss goes to capital. Now the next step, close capital. close capital and get the difference. Nothing is there on the debit side, so the credit card total itself becomes the difference. So 1 lakh, 6 and 9, 115, 115, 75 and 4, 79 and 6, 85. So 85, the difference itself will be the total. So 1 lakh 15 and 85,000. 1 lakh 15 and 85,000. Got it? Now listen very carefully. What I told you in the starting, how the new firm will pay the old firm, that we will see now. So 1 lakh 15 and 85,000 will be paid by the new firm to the old firm. Now what will happen? The new firm will not pay the old firm in cash, but this amount which is payable, they will take A and B as their partners with this as their capital. When you become a partner of a new firm, you bring extra capital now. Now A and B won't be required to bring any extra capital. This balance will be treated as capital of the new firm A, B, C, D. So the new firm will not pay A and B the cash amount. They will tell, okay, now you become the new firm. Whatever amount we are supposed to pay you, 1 lakh 15 and 85, that will now become the capital of the new firm. So the new firm is A, B, C, D and company. So they will not pay. If they pay, they will write to cash bank. This will be transferred to the new company as their capital. So against this, we write the name of the new firm to Mrs. A, B, C, D and company account. And we are preparing A, B, C, D and company. This will go on the credit side of A, B, C, D and company, where you will write by A's capital account 1 lakh 15,000, by B's capital account 85,000. By A's capital account 1 lakh 15,000, by B's capital account 85,000. Got it? And now after doing this, automatically new firm ka account should tally. Debit side ka total देखो 2 lakhs, credit side ka total देखो 2 lakhs. Debit side 2 lakhs, credit side 2 lakhs. Clear guys? So this is the way you will close the books of old firm. Don't worry, again I'll revise this with you all, and in the next video I'm continuing the same thing which is connected with CD and company. Same concept will come. I'll repeat, do the posting, capital put it on the credit side of capital, general reserve distribute among the partners, liabilities, credit side of realization, balance sheet value, assets, debit side of realization, balance sheet value, record the PC, close the account, get the profit loss, transfer to capital, and capital ka balance will go to new firm and new firm will tally. Got it? I am doing the same thing with CD and company in the next video, because I have to prepare the format, also the balance sheet, which I won't be able to do anyway. The video has gone almost 1 hour plus. So I'll wind up this video. I'm coming back in the next video with two things: closing of CD and company and the balance sheet of the new company. And one more thing, when I prepare the balance sheet now, these figures I need. So what I'm doing now, because I'll be rubbing out that part, I'm just putting the answer A and B, 115 and 85. Okay? Because that I'll be requiring for the balance sheet part as I'll be rubbing this. So guys, I'm just winding this video. I'll be back in the next video with the remaining part of the sum.